On our 2-minute OPP, it's obviously just covering the activity of people opening positions, long and short, green for longs, red for shorts, over the last 2 minutes, right? This holds on to it for an hour if they're active. If they're opened after 60 minutes, it'll go away. Or if they close it, it'll go away. So watch what happens on a move lower. So we break out of this consolidation box through these lows. All right. And as we slip lower, watch what happens. Let me open this up here. Watch what happens. Let me speed it up. On the 60-minute. All right, watch in here. We had already on the 60-minute an area right here of the most popular short positions and the price over the last hour. They didn't just come in as it moved lower, because had they just come in, this would have been lit up red. Okay. So this was here as a place where many shorts, and you could see over the last 60 minutes, that's why it sticks out the most popular short position, or what area it's from over the last hour. If you have a lot of stuck shorts, it makes sense why it would be support, because you back it up to what are shorts. Shorts are now buyers. And if you agree that shorts, people who already have a short position, have to buy it to cover that short position, to exit that short position, then they're buyers. A lot of shorts, a lot of buyers. So it's that baby bird example, the story of the baby birds example of some buying down there, desperate buyers that are begging to get out. All right. So now watch what happens as let me clear these drawings here. Now watch what happens as it retests that zone again. Okay. Has what we call this super puke, but that's not what I want to talk about, to be honest with you. I want to go back to where was it? Right here. So a couple things. We're always thinking about what is needed for price to go up or down. And so here's what we know at this point. We know as the market comes down right here that it rallies or retraces, comes back down to test the prior low. And everybody is thinking, does it make a lower low from the previous swing? Does it use it as support and bounce and create kind of a congestion box? What is it going to do? Because there's some risk getting short on a breakout, thinking it's going to do this. Remember, we don't know it's going to do this. We're trying to predict, we're trying to anticipate, and we're trying to stack probabilities as to the chances it has of stopping here and kind of just chopping back and forth, stopping here and rallying quite a bit, or doing what it ended up doing, and that is following through. All right. So underneath this swing low, there was a ton of sell stops, which turned into sell market orders, which is reflected in here, which comes out in this long puke. That's what these hollow green bars are. Longs that puke or longs that exit. I circled the number because it was quite a bit. All right. But right before that happens, is there any probabilities that could either keep you out of a long trade up here? Because if you get long here, you're stuck taking nothing but heat. You want to avoid as many of those trades as possible. See, in this business, everybody wants to know when to open a position to get long. Well, how about disqualifying and knowing when not to open a position to avoid losers? You got to focus and know how many trades you miss that are winners, but how many you intentionally miss because you disqualified them. And so if we bring this back, take a look at, first of all, the OPP lasers green, right? And if we move this forward, we get this explosion of green bars, which are new longs. Now, I'm not going to sit here and tell you what's anybody who didn't get short playing this breakout after you see this is crazy. I don't say that. What I do keep people first aware of is the side not to be on. Everybody wants to get on the right side. How about staying off the wrong side also? And when you get this influx of longs, that these are traders that are trying to see this swing low right here, hold as support for it to go back up to at least here. They're looking for the same thing to happen, because that's what people want. People want to see a pattern that they can make their job easier to do, because once I see this, it'll happen again. And that's all the skill I need to make to pull money out of this market. And so you get this, you get a lot of people most likely playing it for that reason, to the long side. Too many longs, too many sellers, and it's going to be hard to go up. And the market then, sped it up a little bit, finds that sell pressure and then starts to elect some of those sell stops, which turn to sell market orders, and the chase is on. Boom, right there. Happened so fast. This is only for one reason. You stacked up a ton of sell stops rather, that turn into sell market orders. Remember, a sell market order can originate as a sell stop. Not always, but that's not every sell market's a sell stop, but every sell stop will turn into a sell market order if that price is traded. Everybody should at least know the functionality of a sell and buy stop and what it's mostly used for. But that aside, should at least know that a sell stop will turn into a sell market order, unless it's a sell stop limit, but that's a different order type. So these sell stops generally are mostly used and turn into sell market orders once that price is traded. And there were so many of them in it that the chase was on, and it's got to continue to clear out. It's continuing to clear out the bids or the buyers until those sell stops are exhausted. But I want to rewind and just show you when this happens, when you get this OPP to pop and this laser to get longer, it should at the very least disqualify picking a bottom or trying to find a place to get long, or disqualify. I know disqualification isn't the sexiest thing in trading, but when you could acquire the skill to disqualify, you minimize your losers. You minimize the heat, which helps minimize that snowball of bad habits that taking immediate heat from a trade originates from. A lot of people have bad habits of doing stupid stuff. If they put on a trade and immediately take a lot of heat, where do I get out? It's too big of a loser to get out here. All those bad kind of habits begin to stack, or certainly derived from those trades that if you just would have waited a few seconds, you wouldn't have been in this mess. Disqualifying. Most people's problem is they don't even have a qualifying progression, let alone a disqualifying progression. Most people don't even realize that too many longs equal too many sellers. And that's actually bearish for prices, because price is constantly discovering value. Now, Walmart and Target don't have to do this all the time, but if they did, and they had to sell shirts at $20, and I gave this example in the room, and no buyers appeared, and they lowered it to 15, and no buyers really appeared, maybe a few, but not many, 10, a few more. And then all of a sudden, for whatever reason, they go to $7 per t-shirt, and wham, a bunch of buyers appeared. That's price discovery. The price of the S&P mini, the price of crude oil, the price of anything is constantly seeking value, trying to find either the buyers that could keep it from going down, the sellers that could keep it from going up, and the balance that keep it from doing either. And we get insight to that from what we call our chaser. And we're going to talk at length as we turn the year over at this capacity concept, where there has to be sellers. Sellers just don't ever go to zero. All right. Super extreme scenarios, you might see it really low, but even then, you're never going to have no sellers or no buyers. There's going to be a capacity where, you know, at some point, the buyers got to show up somewhere. The sellers have to show up somewhere. And then there's also the maximum capacity where the glass can only get so full. I'm not talking about extreme volatile days, because then all bets are off. I'm talking about normal ebb and flow in 95% of markets. There's only so much selling and buying capacity. And we see that. We don't see this number here. They're not just buyers and sellers that this is recording, but it's also, it adds the emotion of anxious buyers and sellers. And people in the room here every day know what that filter is. The point is, we never see this number get above 4,000 often. I mean, we've seen extreme examples on extreme days with the price flying around. And there's a reason for that, because there's only so much activity that's going to come, that has come to the market. You know, you don't have in a normal day, all of a sudden, this is 1,400 and then it's 8,000. Doesn't get to 8,000. It's not like there's some CME rule to say you can't, there's only so many offers that could be placed in the book. It's not that. It's just the normal capacity of how many people are trading. And here's an example, and I've gone on a little longer in a typical highlight, but I think it's important that I'm talking about it. Here's a good analogy for this capacity concept. If you lived in a town where the only source of food is this grocery store for everybody that lives in this town, you know, everybody, this is the only place they're going to get their food. They don't grow it. They can't get it in another store. This is it. All right. And you know, people have to eat. And you know, there's X amount of people in this town. And this is the only place they come for food. Right. And it's a Monday. People weren't there Saturday. They weren't there Sunday. It's Monday and nobody's here. And the store manager says, hey, get ready. We'll probably get some buyers. And someone says, or people to come in. How do you know that? Because we haven't had anybody come Saturday, Sunday. We know they have to come here. And we know we haven't seen many people. We're going to get a rush. It's the price going down. At some point, buyers have to come in. That doesn't mean you fight price all the way down, fading it all the way down all the time. But you also don't want to get stuck in the hole thinking it's going to go down forever. At some point, people are going to come. And then here's the other thing. At some point, pretty much everybody in the town were here in the last 2 days. We're not going to be busy for a while. There's only so much capacity. There's only so many people in the town, and there's only one place that they're going to come to get food. And we know they have to eat. So people have to get out of positions. What's the one thing people have to do? Do they have to get long? No. Do they have to get short? No. But after they get long or short, they have to exit that position. And I'm talking day traders and a lot of participants that just trade outrights. They're not trading spreads, hedging, or any of the institutional stuff, but people who get long because they think it's going up, short because they think it's going down. And that's the point of a lot of the interaction and participation in this market are day traders, and the influence that we have give probabilities of turns. You don't want to be stuck with the retail herd. And if you do, you've been learning trading the wrong way. Now, when I talk about this, you already have to know that when you're long, you are a seller to cover or exit that position. And now you have to sell it. And you'll get some smart ass to say, well, if I buy more, yeah, Yep, you could do that. You could add to it, and I get it. But you should understand that at some point that position has to be exited. So you have to sell it. You don't have to buy again to add to it, but at some point you're going to have to cover that position. Another smart ass. Well, what if I keep it for 2 weeks? Everybody else should get the point. And so those are the sellers when you know they have to do something. Most people have to do something and wait and wait and wait, become more and more anxious if price and the position is going against them. And so if you don't start from understanding everything you do, even after you learned it, from the notion of after you're long, you're a seller, after you're short, you're a buyer, and so is everybody else whom are day traders, you start to understand that there's only so much capacity to buy and sell, and price is always trying to seek balance. It's trying to seek, we can only go down so much, and at some point buyers show up. You can lose a lot of money looking for those buyers. So you have to have a progression. You're not just fading every time the market breaks, knowing that eventually it's going to rally. Eventually it's going to bottom out. It's a terrible approach. You just have to qualify and disqualify those particular ideas. And too many people do not qualify a good idea. And then more importantly, do not disqualify a bad idea or a good idea at a bad time. Timing and location go together. And so when you don't have a good mechanism to qualify and disqualify, or as we call it, fire in the ready, aim, fire, or step 3, if you don't have a good qualifier or disqualifier, then you're going to really struggle at finding your timing and your location to execute your idea. Because the idea is useless if your locations suck. All the good ideas will be are frustrating because you'll be right and lose money, or you'll be right and have to take a bunch of heat before you make money. So if you got great ideas and bad location, you're just going to be frustrated. And location comes with not just price. It's another fallacy, misnomer, rabbit hole people go down. What's the best price to get long? No, what's the best time and price to get long? Because 53 could be a better place to get long than 50 even. Well, I'd rather be long 50 even than 53. That's what the mathematician would say. But it's the timing of, does it do this at 50? So you're long from here and all it did was bust your stones for 20 minutes. And then when it got to 53, bam, it rallied. Would you rather be long here or would you rather be long closer to here? Again, the mathematician, the novice would say lower is better. No, it's the timing of how long are you sitting with that risk? Because if it takes long for the trade to go up, you're inclined to talk yourself out of the trade. You're inclined to take a small winner, small loser, and then miss the move. You want to always keep working on getting it closer and closer to not sitting on the position and it's not going your way. It's going your way and you're sitting with it, different story. That's the true definition of a good location. How long does it take for your position, your idea to start working? Because investors are going to start, if you use the analogy of going out and getting angel investors, the longer it takes for you to start to turn the corner and have your idea turn to be profitable, the more frustrated and anxious they're going to get. So it's the same with your trade. Timing. Most people just want to use price as the definition of a good location. But something has to happen at that price to stack the probabilities that that indeed is the good price. That is the good location. This is the timing where we should rally or break. Not just the price, but both the qualifying and disqualifying tools you're using to stack probabilities.